think that one of the biggest issues a lot of business owners have is not so much how can I, let's say make more money. The biggest issue that we come across is how can I eliminate or minimize my taxes owed? I want to transfer my corporate assets to my family, but they're stuck in my corporation, right? So that's one of the biggest problems that I see end of life for most business owners.
Hey everyone, it's Kenneth here, and I got a special guest today, Erica Lee. She's my own personal insurance agent, life insurance agent. And the reason why I want to bring her on today is to talk about the benefits of having life insurance if you're a real estate investor, if you have a lot of assets to protect, and even if you don't have any kids to, I guess, protect as well too. This is not for people that already, well, I guess it is for people that have life insurance. Maybe you have to reevaluate it, because I did have another broker before you. And the reason why I switched to you, I mean, she was amazing and all. The reason why I switched to you is because you understood how to deal with investors and how to structure life insurance really for
I think
that.
life insurance, and I will talk about this a bit too in my presentation, but life insurance it's so different than what people used to think of it. And it's such an effective tool, but you have to really understand how to use it and how to use the different products available to you for each specific client. Like I said, that's the part I love about it, working with different people. Every one I meet, it's a different case. Right? So one size never fits all in insurance. And that's what I always tell my clients, because if someone's going to come to you and tell you, well, this type is the best type of insurance, I would definitely say that they probably don't understand it well. Because again, Canadian insurance companies have done an amazing job at creating so many different products, because those are different solutions for so many different problems. And each one is different. So one is not better than the other. It just is depending on you and your situation.
Right. And your industry got a really bad rep, I guess, or at least to me, it got a really bad rep because of, America, like those, like, things like that, right?
I would
The
say
whole pyramid schemes.
America is a very different type of insurance company. And like I said, their whole, ideology is to buy one type of insurance and that's it. To invest the rest, essentially. So like I said, I think it's a lack of understanding of the products and how you can actually use them as tools. And just thinking that, only one is good is such a, to me, a very simplified mentality. And again, it's a lack of understanding of the products and how to use them. So you need to make sure that your broker understands the different types of products, the different companies, and what they offer, because each company offers different products as well.
Okay, so I don't get paid for this. I'm not getting a kickback from you or anything like that, but it's really powerful. In my 40s, I finally realized the power of it. I wish I started earlier, and hope anybody watching this has started earlier as well too, particularly if you have investments, real estate investments, to cover off your, to hand off when you die, because eventually you're going to die. So for me, the reason why
I haven't solved that problem yet.
Yeah, exactly. Well, not yet. But so the reason why I came to you is, and luckily I found you, I got introduced to you, is because like my primary strategy is to invest in real estate, go heavy on real estate. But then what you got me is that if I die, how are they going to pay? How are my successors going to pay for the capital gains?
Exactly. And I'm not the type to say, no, don't invest in that. I've always thought that insurance is what I call like an umbrella investment. It's really to protect all of your other assets and investments that you work so hard to build and grow. So it's really something, it's more of a protection for everything else. And we'll talk about that and how you can actually use it.
Sure. And then you're going to get into, I guess, how insurance could be used as an investment, because I was like, oh my God, that's how you sell me. So it's really primarily as an insurance vehicle, and then becomes an investment vehicle after that.
Exactly.
As
So it's
a really
both.
nice benefit.
Both worlds.
Okay, so I know we have a lot to ground to cover. We only have an hour, or we'll try to keep it under an hour. I'm not sure if you can do that or not. So I'll hand it off to you. Actually, first of all, why did you get into it? So I know you love helping people. I know your family's generations in the business. So
yeah.
What is it what's your story?
Honestly, I don't have some big story as to why I got into it. It's honestly, my dad, like I said, he's been in the industry for so long now. You don't meet too many insurance advisors that have been in the business for 30 plus years. But again, I got into it right out of university. I took the time, like I said, to do my designations, and really I delved right into it and tried to learn every single aspect and every single corner of the industry. I started working with clients with him, which I was so lucky to do so, because I think I really got to experience what it was like to be an insurance advisor, which to me is not the sales part. I think our job is really when it comes down to like the death claim part, unfortunately, right? But that's really what I do. And I find so many new agents don't get to have that experience in the first, let's say, 5 years of their career. And because I had been working with my dad, I was actually very lucky to be able to be there during those times and to actually see what it is that we do, which is helping people at one of the most difficult times of their life. So that's probably what kept me in the industry, really seeing that how much help you're actually giving to people. What we do is probably the only person at that time of that difficult, period where I'm coming to you. I'm probably the only person coming to you with a check, and that's it. Nothing else. Everyone else is coming to you with bills, with hardships and just tasks, right? We're really the only people coming to you at that time just with help, and that's it. And that is just because, your loved one took the time to plan.
Right. So I know that insurance is obviously different for every single person, every single situation.
Mm-hmm.
We had some clients where they inherited properties, and it seems like a great thing to inherit a multi-million-dollar portfolio or whatever. But then when you're taxed with several $100,000 of capital gains, you got to pay right then and there, or else you don't get the property. That can actually happen to a lot of people, like that inherit properties, and also that if you're passing on properties. So for our investor clients,
A lot of people, sorry to interrupt,
no,
a
go
lot
ahead.
of people don't realize that that's the case. And that's a little bit surprising to me, how many people don't realize that that's the case. They're aware that there will be taxes, but they're not aware of how significant those taxes will be. So we're definitely going to talk about that today, and how it works, how it's calculated, and what we can do to prepare for that.
All right. So why don't you get into it?
Okay, so like Ken said, thank you for that amazing introduction, but he really was pretty amazed at how effective of a tool insurance was, especially with regards to real estate investments. So he asked me to put something together in terms of really like focused around that problem. So that's what I've done for you guys today, talking about what are the problems that you're faced with, what are the possible solutions that you have, and we'll go over briefly the different types of insurance so that you have a general understanding, because that's another thing I find a lot of people don't really have a general understanding of the different types of insurance. And then we'll just talk about the different concepts and how you can actually take advantage of what's available to you. So the problems, we already kind of talked about it a little bit, Ken, but obviously the biggest and most obvious problem is going to be the taxes. So taxes is going to be the most expensive tax bill of your life, most likely, and most people aren't prepared for something like that. Liquidity, fulfilling your end of life wishes and optimizing your total net worth, as well as I'm going to touch on meeting financial obligations in the event of a premature death or illness.
Okay, so taxes is basically capital gains. Okay, so there you go. All right, cool.
Exactly. So taxes, we're going to mostly talk about the capital gains taxes, because that's really what is facing real estate investors. So currently capital gains taxes has a 50% inclusion rate, which we'll go over a little example on the next slide. But what that means is that when you take your total gain, 50% of it has to be included in your income. So that's the capital gain. That's going to really, pose lots of, that's going to be a big tax bill for most people, especially with the way the Canadian real estate market grows. As well as, I just want to note that although it's a 50% inclusion rate right now, there is some uncertainty with that, because it could go up, it could be eliminated, and they say no more capital gains. The whole thing is taxable. So that's something that I would say is not unrealistic, especially current state of our economy and things. So that's something to note, but it is a 50% inclusion rate right now. Okay.
So step back a little bit really quickly. So you have $1.5 million property that you either inherit or pass down to your children. So depending on which way you're looking at the life insurance, say we're passing it down to our beneficiaries. There we go. Oh, awesome.
You're
Okay,
literally
so the reason why you need capital
the same
gains,
number that I made.
there you go. That's hilarious. I didn't even see the slides yet. So okay, so
Exactly.
actually you run through it. Yeah.
Yeah, so let's just assume you purchase a property, or let's talk about if you're purchasing a property and you're talking about it and you want to pass that on to your family. So you purchase a property for $1.5 million. The future value in 20 years based on a 5% annual growth rate. That means that in 20 years, that property would be worth just under $4 million. Okay, so that leaves you with a total gain just under $2.5 million. Okay, so we talked about the 50% inclusion rate, which means 50% of that total gain is your taxable capital gain. So that means 1.239 million has to be included in your income in that year. And that's obviously going to push you into the highest tax bracket, which means 50% of it approximately is going to be owed in taxes. So that's going to leave you with about $620,000 that you have to pay in taxes just to pass that property on. Now let's assume you have 5 of those. Okay, so that's going to leave you with over $3 million, assuming you have 5 of those very similar properties with similar growth. Okay, so I'm going to go back one slide, just so we can go over the other problems as well. But of course, capital gains taxes is definitely probably the thing that's on most people's mind. How are we going to pay that tax bill? How's my family going to pay that tax bill? How are they going to be able to do that? Okay. And the next thing kind of, plays into that, which is liquidity. Certain assets, although real estate is a liquid asset, it's not as liquid as you may need it to be. Okay, as well as there is the potential risk, of course, and you know better than me, Ken, but there's always the risk that you can't sell a property when you need to, or you can't sell it at the price that you would like to. And all of those other things really pose a risk if you have a need for cash immediately. Okay.
Or there's a vacancy and sorry, go on.
No, go ahead.
Example of that would be like a vacancy if the tenants leave and you're stuck paying the mortgage and you can't pay it.
Exactly.
This is like down the road, right? This is probably a way.
Yeah. So even things like, just having a difficult sale, even if you can sell it quickly, but the closing is in 3 months, you don't have the funds until the property's closed. So depending on how quickly and what the cash needs are at that time for your family, the liquidity poses some sort of risk because you may need cash right away. Okay. Optimizing net worth and fulfilling wishes. Like I said, every client is in a different situation. So what they want and how they want to distribute their assets is going to be different. So depending on, what those wishes are, you may build up a very significant rental income property portfolio, and you really want to pass that on to your children so they can continue to maintain those properties and continue to receive that rental income. So if that's your wishes, then, even selling the property and the liquidity is not even an issue, because now you want to figure out how can we distribute those assets in a way that they can actually maintain them. So this is something that we have to wishing is always great, but we want to make sure that you have the funding available so that those wishes can actually become reality for your family. Because one of my favorite quotes is, failing to plan is planning to fail. And I love that because it's so true, right? Wishing is so great, but if you can't actually put those things in place, then really what good is it to even have those thoughts, right? And then maintaining expenses. So this is a little bit more what you were talking about just now, in the sense of, let's say a tenant is not there, you have a vacant property and your family needs to be able to maintain those expenses and meet those financial obligations in the meantime. So something like that is important, that they have, again, the cash available to them immediately. So those are really, I would say, the biggest problems facing real estate investors. Do you have anything that you've come across, Ken, that you would probably add into that?
Yeah, I mean, I would say like just tax bills that come up that are unexpected. Sure. If you don't have the rental income coming in, I think that would be the biggest thing, probably in this situation. Yeah. Well, so every situation is different, obviously. So
exactly, every single situation is different. So we went over this, and again, like I said, this is on one property that I'm looking at the value of 1.5 today, which is a very average property price, right? And again, based on the 5% annual growth. So a property like this, and the capital gains, again, it's just important to note, just for anyone who doesn't know, but that would be on any investment property, any property that you have above your principal residence. Okay.
Right. So I haven't been through it yet, but if somebody passes and you inherit that property and you can't pay that bill, they will force the sale of it. And then
Well,
is
you'll
that how it
definitely
works?
have to do something to come up with that bill.
But if you can't,
Otherwise, the assets don't pass, right?
that's
Like,
right. So 619,000, yeah, you don't get the asset really, and they'll have
exactly.
to either
So
force the sale of it and you get the proceeds after that,
whatever's
or that's
left,
it.
or other assets, or that kind of thing, right? Like, either way, I mean, I think there's only a few things certain in life, and it's probably death and taxes, unfortunately.
Yeah. And
So
investments, yeah.
exactly.
No,
So
sure.
taxes, it's going to have to be paid one way or another. And then that comes to my next slide, which is, how can we pay that? How can we pay those tax bills? Well, there's one option, which is probably the most obvious, and that's literally just to pay it. Use cash and pay your taxes. Now, that's going to cost you $1 of your cash to pay $1 of tax. That's going to significantly reduce your total net worth that you're passing on to your family. And again, I don't come across too many clients who have millions of dollars sitting in cash that is just readily, that they can pay out to their taxes. Okay.
Plus, it's after tax cash too, right?
Exactly. So, nowadays you don't find too many people just sitting on millions of dollars of cash, right? There are always things to invest in and to put that money into. So again, but if you do have it, it's just important to note that that's going to cost you $1 to $1 of tax. Okay. The next one, and unfortunately one of the common solutions that people have to do, is to borrow the funds. So they would borrow money to pay the tax bill. This is going to end up costing you more than $1 to pay $1 of tax, because you're going to have to pay back not only the loan, but interest on the loan. And again, that's also going to significantly reduce your total net worth that you're passing on to your family. The third one, which is what we just briefly talked about, this is going to be selling assets to fund the tax bill. So again, that's going to pose many risks in terms of liquidity. Is it the best time to sell? Are you able to get what you believe is, the property's worth? As well as that may not have been, your family's wishes. We talked about they may have wanted those properties to pass on to you to maintain them, to be able to continue getting income from those rental properties. So that might not be what they wanted you to do, but unfortunately, some people are forced into this solution. And then the fourth one, and the most cost-effective way, is going to be using insurance to prepay taxes while living. This is going to be the option that maintains or even increases your total estate value to your family. So essentially, you can think of, let's say we know, based on the example right before, you're going to have a tax bill that's approximately $620,000, or whatever the number was. You can, while you're living, you pre-buy a life insurance policy for that amount, and that's going to cost you cents on the dollar. Okay, because depending on your age and gender and your health, of course, but that's going to cost you a fraction of the dollar, and that's going to leave your family with the amount that they need in cash, and it's tax-free, and they can use those funds to pay for the tax bill at that time. So you're essentially, you're eliminating tax by prepaying it while living. Okay. So what types of insurance are there? And I just wanted to go over this briefly, because I know a lot of people aren't aware of the different types. You mentioned Primerica, and, they only, talk about term, for example. So I wanted to go over, because I know a lot of people aren't sure about the different types. Were you sure? Were you aware of like the different types available to you?
I just didn't think I needed whole life until I realized that it could be an amazing investment. And that's was like, oh my goodness, I need way more whole life than I need term. I mean, obviously you need both, I think.
Right.
And then universal life, forget about that. I think I don't know. I personally think it's kind of a scam, but you know better.
Which one?
Universal.
Oh, universal.
Anyway, whatever. We spend this in whatever. I don't know what I'm talking about. You're the expert. Go for it.
Okay. So what I want everyone to do at this point is literally just throw out what they thought they knew about insurance. Whatever you think insurance is, I just want you to kind of get rid of that for a second, and replace it with this. Insurance is really just, you're buying tax-free discounted money from the insurance company. Okay, so simply put, you're buying money and you're just buying it at a tax-free discounted rate from the insurance company. So that's why it's such an effective estate planning tool, because it's literally just cash. Okay, we have death claims paid out, in 5 business days, where the money has been electronically deposited into the beneficiary's accounts within 5 business days. And again, it's a lump sum, it's tax-free, and it's just money. Okay. So there are a few different types of insurance, and this presentation is really going to focus mostly on the life insurance side, but I'll just briefly go over the living benefits. So life insurance, obviously, we talked about, it's going to pay out a lump sum tax-free amount to your beneficiaries when you pass away. And then we have living benefits. So there's disability insurance, which pays you while living a monthly benefit. It's also tax-free. If you were to ever become injured or sick and cannot work. Okay. Critical illness is a lump sum tax-free benefit, also paid to you. And that's going to be paid if you become diagnosed with one of the covered illnesses under the policy. So the big ones would be like heart attack, cancer, stroke, but it would cover, most policies would cover like around 25 different illnesses. So living benefits, it's because it's actually paying to you while living. And these things are really important too. We're not going to talk too much about them in my presentation, but it's important to look at those, and to have a full insurance plan, you really need to be looking at all of them. And that's because, what if something happens to you, but you're still alive, right? So let's say become diagnosed with an illness, or you become injured and you cannot work. So these are really important to continue maintaining the expenses in that one problem we talked about, because if you can't work, who's going to continue to pay your bills, right? Especially when we're talking about like real estate investors, self-employed, entrepreneurs, and that kind of thing. We don't have any kind of benefits. We have to create our own benefits plan. So that's what these things are going to solve in that sense. And in terms of life insurance and critical illness, they both have what we call term insurance and permanent insurance. So the difference between the two, term insurance is more of a temporary type of insurance. And the reason I call it temporary is because the premiums are not necessarily locked in. They do increase over your lifetime, depending on the type of term you've chosen. And it also has an expiry date. So most companies, the term policies would expire around age 85, let's say. Now, term insurance, like I said at the beginning, one is not better than the other. They're for different needs and they solve different problems. Term is great for protecting things like your income over the next 20 or 30 years. It's great for protecting mortgages over 25 years. And so term is great for protecting specific needs. And the one benefit about term is that you can get a large amount of coverage for very minimal cost. And that's again because of the temporary features of a term policy. So term kind of looks like this. This is an example of a 10-year term where the person starts the policy at age 35, and every 10 years the premium increases. And at age 85, even if you can afford the premiums at that time, because as you can see, it's a significant increase as we age, the policy expires after the expiry date. So there's no more coverage, there's no values in the policy after the expiry date. Permanent insurance is exactly what it sounds like. It's permanent. Within permanent insurance, there's 2 types. So there's the universal life and the whole life insurance. Both of those are permanent life insurance. The difference between the two really comes down to the investment component of those policies. But both of them protect you for your entire life. You can lock in your premiums at your age when you buy the policy. So that way the premiums don't increase. You know exactly what you're paying into the policy. You can also pay off these policies after a certain number of years. So you can choose, let's say like a 10-year premium paying period, 15, 20. Again, each person's different. It's going to depend on, their age, their budget, and so on. But you can pay off these policies and have the coverage for the rest of your life. So permanent insurance is a great estate planning tool. This is what permanent insurance would look like. So again, you have the coverage forever. So it's going to cover you until the day something happens. And you can choose to pay off the premiums, let's say in 20 years. After that, it would be paid off. or 10 years would be a little bit more expensive in terms of monthly premiums, but total premiums would be a bit less, and so on.
So just really quickly, so this graph in this example, after you're 20 years old, or you're 20, sorry, that shows zero. So no more payments. The policy is paid for itself through the insurance, that the residual income that it produces. It just pays
It's
for the
actually
premium.
not like that. It's just
Oh,
paid off.
okay, so
Yeah.
completely
So
paid
the
off.
old were more like that, where
Okay.
they didn't have guaranteed. These are guaranteed limited pay cost of insurances.
So
So
even
what
if you
that
die at
means is
100
your
for,
cost of the
sorry, I was just saying, even if you die at 100
the policy.
for just regular,
Yeah.
old age or whatever, you still get paid out that full amount.
Exactly. So it covers you for life. There's
Awesome.
no expiry date on permanent policies like term has. So there's no expiry. It covers you forever. But where they do have, let's say, like an expiry, is the expiry on the premiums owed. So you don't have to pay premiums after, let's say you have a 20-pay policy. After 20 years, the policy's paid off. Your premium paying period is done, but you have the coverage for life.
That's powerful.
So that's huge. Like, think about people in our age range, right? Like where we are in our 30s and 40s. So we're young still, right? Like we still hopefully have, 40, 50 years left in our life. And to be able to pay off a policy and lock in our premiums at our age today and pay off those policies in, let's say, 10 years is a huge advantage for younger people, because no one wants to be paying a policy until the age of 100 possibly. Okay, so that's the potential of paying that policy for 50 to 60 to 70 years, depending when you start your policy. Can you imagine selling a house and being like, we don't know when you have to stop paying this policy, you'll just have to pay it forever?
Yeah, well, that's what term is, right? So
Exactly. Well, terms even a
it's
little
just a
bit
lot
different.
cheaper.
Yeah, exactly. So
Anyway,
really, I mean, when I compare the two, one example that a lot of people really understand is term insurance is more like renting a house. Okay. So you have that house to live in, you have the protection. If something happens to you, those policies get paid out. But every, let's say, 10 years, your landlord's going to increase your rent. And at age 85, they kick you out of the house. They're no longer going to rent to you at that time. Okay. Whereas permanent insurance is more like owning a house. So upfront, it's definitely more expensive than renting. So it's definitely more expensive than term insurance. But after that 20 years, you're done paying into that policy and you own it for the rest of your life. As well, there are cash values in permanent policies. So there's actually value growing in these policies every year. So not only are you done paying the policy and you have it for life, but it's actually growing in value. Okay. So depending on whether you go with a universal life or a whole life policy, that's going to really determine what investment tools in the policy are available to you. So whole life insurance, and this is the one that you really were attracted to, Ken, is because the insurance companies actually pay dividends into the policy. And what you do with those dividends, it's up to you. There's a few different dividend options, but majority of people put them back into the policy. And those dividends are actually used to build up not only a cash value that you can access while living, but it also is going to be buying paid up additional insurance into the policy and increasing your total insurance coverage over time. So whole life is great because you don't have to manage it yourself. The insurance companies are paying profits into these whole life policies essentially. Whereas universal life, you have the option of putting additional dollars into the policy, and that can be invested within the policy in a tax advantaged investment account. If something were to happen to you, it could be paid to your beneficiaries and it's added to the death benefit, so it would be paid out tax-free. So both of them have really unique investment tools in them, and that's unique to permanent insurance. Term doesn't have those options available to those policies.
right.
Okay.
So while permanent insurance is a lot more expensive, you can borrow against. I'm sure you get in this presentation, but the reason why I got attracted to it is because you're just paying the premiums anyway. But what you can do is you borrow against it if you need to invest, right? So basically, you get the money back
So
while you're
there's a
still
lot of,
living, which is pretty cool.
I don't even like using the term expensive, because when you look at it in the grand scheme of things and like over life, if you really look at, let's say, term insurance, yes, it's expensive compared to these first few years, right? But later on in life, you would say it's cheap.
Yeah, that's true.
Right. So yes, it's expensive up front, but it's not expensive when you really think about what are you getting with that policy, in the sense of you're paying off, the insurance at a very discounted price. That's why at the beginning you were saying, and again, I always agree, the earlier you do this, the better, because you're locking in your cost of insurance at a younger age, which is less premium. So you're actually, over the long term and over lifetime, it's actually cheaper if you think about it, because at this point, like, let's assume someone kept a term policy throughout life and they're paying these here and they live past the expiry date. Those premiums are gone. Yeah. There's no coverage that's going to be paid out. There's no cash values in a term policy. So that's all gone, right? You paid for the coverage. If something happened to you, it would pay out. But if not, then the policy is gone. Whereas on a permanent policy, like we said, I mean, it's not a question of, is the policy going to pay out? It's only a question of, when will the policy pay out? But again, just like you were saying, yes, there's values that are growing in this policy over your lifetime that if you needed to, you could borrow against. And so it's really, like we said, it's an asset with value to it. You're adding an asset to your portfolio, right? So this is not only insurance protection, but it's an investment asset where it gives you the best of both worlds. It gives you the protection that you need, as well as, you can access it while you're living.
So it's cool because Erica is really awesome at this, and you found a really good balance for me anyway, for what I wanted, a mix of both. Like, you don't have to pick either term or permanent. You can do a mix of both. You should do a mix of both. And you found a really good thing for me based on how much money I want to spend on the premiums versus how much coverage I want to get. So it's like a kind of a lever.
Exactly. Really that's an amazing point, because I think a lot of people think they have to choose one or the other. And that's not the case. In fact, I would never want to be pushing just, like, let's say, all permanent and leaving you underinsured, because that's really what it will likely come down to, especially for younger people in the earlier phases of their careers and their lives, right? Where, think about younger people who are just starting and just investing. They probably have the largest amount of debt at that time in their life and the smallest room in their budget for insurance. So we don't want to be uninsured or underinsured just because you can't afford to protect your entire need in permanent. So most people would have a mixture of the two. And over your lifetime, you're going to be changing your insurance also. It's not something that you're going to do one time and just leave it as that. You're going to constantly look at the term policy and see if your needs are changing. Do you need more? Do you need less? Same thing with permanent. Do you need more permanent insurance? Because that way you can increase it. And term gives you the ability to do that without having to show medical evidence of your insurability. So it's term insurance, like I said, I would never say one's better than the other, because it's not. We have to look at where you are in life, what are your needs, and make sure that your advisor does a financial needs analysis to figure out what is the need. Because I think a lot of people are probably surprised at what your family would be left with if something happened to you tomorrow. So correct me if I'm wrong, Ken, but most people know what they have and what they own, but they don't realize what would be payable if something happened to them tomorrow. Or maybe it's not that they don't realize it, but they're not thinking about it.
Well, yeah, that's how you got me, right? Because you really you took the time to do the needs analysis, and you really had to, because it's individual to each people, to each person in your situation. So you really got to know my situation first. You figured out approximately what my capital gains would be. And you said, you probably need this much amount of insurance, plus, have you thought about this and thought about that? And then added up a little bit more. So that's, I think, the power of what you do, specifically Erica Lee. And I think you should take the time to really understand what it is that you need before you figure out how much. That'll probably answer the question for you.
Exactly.
So good job.
Because not only is it a question of how much do you need, it's also a question of what do you need. We've kind of briefly gone over the two different types of insurance, and I think it's obvious how different they are and how they will help you in different with different issues, because one is not going to help with the same issue, right? Permanent insurance is going to be what we're doing for estate planning, making sure that when something happens to you, your family has the ability to meet all those obligations that they're going to be faced with. And term is really to protect not only yourself and your loved one, but children in the event that something happens to you very prematurely and you're no longer there, you're no longer earning an income, and so on. So they're very different. And that's why I say, yep, the premiums are very different. It's obvious why they are. So it's important to understand the two, and we can definitely figure out what is the right mixture and the combination for your specific scenario. And I wanted to talk quickly about corporately owned insurance, because I know this is something new to the real estate industry, not necessarily to real estate investors, but it's new to real estate agents. So the ability to incorporate, and obviously there's a lot of benefits of incorporating. So I just quickly wanted to touch on the benefits of corporately owned insurance and why, what benefits do you get by having your insurance policies within your corporation? So obviously we know that real estate agents have recently been able to incorporate with their professional real estate corporations. And what does that mean? So let's say you have a policy and you own it with your corporation. That's going to mean that your company owns the policy, it pays for the policy, and it's the beneficiary of the policy. So having it set up in that way is going to allow you to take advantage of the cheaper premiums. And why I say cheaper premiums is because regardless if you have a policy, personal or corporate, you're using after-tax dollars to pay for your premiums. So when you have it in your corporation and your corporation's paying for the policy, your tax rate on your retained earnings, your tax rate on your revenues in your corporation are going to be taxed at a much lower rate than if that money was paid personally. So you're having to pay less tax to be left off with the same amount to pay that same premium. So you're essentially paying less when you're looking at gross dollars for the same policy when you have it in a corporation.
So this also applies to not only real estate agents that are incorporating, but also entrepreneurs that have their own companies and own businesses and corporations, or even like self-employed consultants that have a corporation and take their money that way. Or doctors.
So when you have a corporation, exactly, I would definitely talk to your advisor and see if this works for you, and that you can have that policy in your corporation and take advantage of that, because exactly right, it's not just real estate corporations, it's corporate owned insurance.
So I've heard some advanced strategies where you have a huge premium and you borrow to get that premium, or whatever it is. You pay for it with pre-tax dollars. Then you build this massive cash value, and then you can draw down on it through a loan, I guess you could say, on it, and you take basically your salary that way by using pre-tax dollars. How does that work?
So that's what we call like immediate financing arrangements. It's using a policy, a permanent life insurance policy with a cash value. And exactly, you can, I don't want to get too into it because it is definitely a little bit more detailed. And I would say each person, I would want to go into it in detail with that person. Sure. But when you use the cash value to take a loan, and there's a few ways to do it, because you can do it in the future. You can build up the cash value in a policy and borrow against the policy. This is how we talked about it, me and you, Ken, where you build up a cash value and in the future, you actually borrow against the policy, against the cash value of the policy. Another way to do it is, and why it's called an immediate financing arrangement, is because instead of waiting until, you're going to do it more in the earlier years of the policy, where you borrow against, you can borrow, let's say, up to 100% of the cash value, and you obtain a loan against that cash value, and you're using the insurance policy as collateral. Now, the issues with this that it's important to understand is that because your policy is corporately owned, sometimes the shareholders want to use these loans personally and not corporately. Because remember, when you have a corporation, I know this is new in terms of the real estate industry. So it's important to understand that when you have a corporation, it's a separate entity from you. So a shareholder and their corporation is not, one together. Okay. So they're completely separate entities, where if your corporation owns your policy, that the benefits of that policy are to the corporation. Okay, so you can't just take a loan against the policy and take it personally to use the funds personally. And if you did do that, it's important to note that there's going to be guarantee fees that the shareholder has to pay to the corporation personally. Okay, so there's a lot of implications, and in terms of the rate changing, let's say we actually borrow against it in the earlier years and then the rate changes, because you have to reassess it every single year. It's important to note that, let's say the rate changes and now the bank or the lender requires additional collateral. That's something that you as the business would have to come up with, and if you can't, you're going to have to pay back the loan. Okay, so this is something that, again, like I said, I would prefer to get into this one-on-one with people, but it is good to note that there's lots of concepts available. How you structure it is going to be dependent on, again, you and what you're really looking for, what the intention is with the policy, and that kind of thing. But there is definitely a lot of different concepts available. But what I'll talk briefly on, and that's what's here, is accessing the policy's values while living. So depending on what concept you use, we will get into that again one-on-one. But accessing the policy's values is what we're really talking about. So let's say whether you're doing it earlier or later, the point is that you know that that policy gives you the option. You can look at the cash value of a life insurance policy as the equity in the policy. So as an equity in the house. That's available to you to either completely withdraw and cancel your policy, let's say. And most people wouldn't do that because it's taxable if you do it like that. And you lose your insurance coverage. Okay, so most people would borrow against and access the values in that sense by borrowing against the cash value. That way it's not income, so it's not taxable. You haven't changed anything in your policy, so the values are still growing. Although you're paying interest on the loan against the policy, your policy is still growing. So it's kind of offsetting each other depending on what the dividend rate is that's going into your policy. But those are things that is a huge advantage, especially when you have the policy in your corporation. You're funding it with corporate after-tax dollars. So like I said, it's cheaper premiums.
Corporate after tax, but before personal tax. So that's awesome.
Exactly.
All right, cool. Sounds good.
And then the other thing is corporate estate transfer, which I just wanted to touch on. I think that one of the biggest issues a lot of business owners have is not so much how can I, let's say, make more money. At the end of life, the biggest issue that we come across is how can I get my money out of my corporation and pay the, minimum tax? How can I eliminate or minimize my taxes owed? I want to transfer my corporate assets to my family, but they're stuck in my corporation, right? So that's one of the biggest problems that I see end of life for most business owners. And when you think of corporately owned insurance, it's essentially allowing you to transfer assets from your corporation to your beneficiaries and actually increase what you're transferring them. So just think, for example, you have $1 million of cash in your corporation, and you want to transfer that to your grandchildren or your children. Okay. If you were to just withdraw that and transfer it to them, or just transfer the cash to them and they withdraw it, you're going to be left off. They're going to be left off with, let's say you pay it as a dividend. They'll be left off with $650,000 of your $1 million after they pay a dividend tax, let's say. Yeah. Instead, what you could do while you're living is say, okay, Erica, I want to buy a policy where my premiums equal $1 million over 10 years. Okay, so I'll pay you $100,000 every year for 10 years. So you're essentially transferring your money from one bank account to another bank account that I like to call life insurance. Okay, so you're going to transfer 100,000 from your $1 million to another account, which is the life. And when something happens to you, that policy is going to pay a death benefit to your beneficiaries of $3 million tax-free. Okay.
It grows. Yeah, exactly.
The death
also an investment as well. Yeah, exactly. Cash value grows.
The death benefit alone. So let's say my premiums, $100,000 a year for 10 years, are going to buy me a policy with a death benefit of $3 million. Again, it's going to depend on your age, your gender, your health. So this is just an example. But you've essentially taken the 1 million that would have been 650,000 to your grandchildren and turned it into 3 million. Okay. So that's why I call it like a corporate estate transfer.
Awesome.
Okay, so this is how most people are like, okay, well, if my corporation owns my policy and is the beneficiary of my policy, how does the money get to my family? And that's obviously we flow it through what's called a capital dividend account. Okay, so a capital dividend account is just a notional account. And there's a few things that can actually be credited to the capital dividend account and be paid to either your heirs or the surviving shareholders as a tax-free capital dividend. One of those things that are allowed is the death benefit of an insurance policy, less what's called the adjusted cost basis. So this is really just, depending on when something happens to you, the adjusted cost basis starts off very low. It increases, it peaks, and then it goes down and goes to zero at a certain point in your life. And again, this will depend on how old you are when you buy the policy, the amount of insurance you're buying, and so on. But that's essentially the shape and pattern of how an ACB, goes over time. So when you have that policy, you have your professional corporation, you have your policy that's owned, paid, and is the beneficiary of your insurance policy. And when something happens to you, the death benefit gets paid to your corporation tax-free, and the death benefit minus the ACB gets flowed to the capital dividend account and gets paid to your beneficiaries tax-free. Let's say there was, adjusted cost basis at the time of death, because let's say something happened to you prematurely. That amount isn't gone. It's in your corporation and isn't allowed to flow out tax-free. Okay, so that's important to know, because I find a lot of people ask, so what happens to that amount? So it still was paid tax-free to your corporation. It's just a matter of, do you need to get it out or not? Okay, and if you need to get that portion out, you can dividend it out. It's minimal compared to the death benefit.
Do you know what the limit is for the capital dividend account?
I don't think there's a limit in the sense of each payment. It's going to depend on each item that is actually flowing through there. So if it depends on the what is actually flowing through. So death benefit less the ACB would flow through.
Okay.
And again, this is something, I want to just tell everyone that these are things like we'll get into more detail. I know it's a little bit general. I think me and you talked for a few hours on our first meeting, right?
If you're going to talk to Erica, it's going to be prepared for like 3 hours. She's patient, which is awesome, but there's a lot of stuff to cover.
So there is a lot to cover. And again, especially when we're getting into, the corporate side of insurance, there's a few more things that we need to go over. So it's important to just, set aside the time to make sure we go through everything for your needs and that kind of thing.
Awesome.
So we talked about some of the concepts already. So accessing the cash values, whether it's in the future or immediately, is one thing, one concept in terms of using the values while you're living, as well as still providing the insurance for your loved ones. So it's just not necessarily, I wouldn't call it like, let's say, a concept. It's something that you want to make sure that is available to you with your policy. As well as we talked about corporate estate transfers and just insuring children and parents. I don't think we talked about that in yet so far. So I just want to quickly touch on it. It's really important to make sure that, one, let's say for children, especially when you're talking about a very large estate transfer or inheritance to them, that it's important to understand what their tax bill would be for their future children or their future beneficiaries. So even preparing them for that is something that you guys can do while living and while the children are young. Locking in their cost of insurance at a young age is going to significantly reduce the premiums paid into the policy also. So insuring children and preparing for their future protection is one really important concept. And insuring parents, I think that's something that a lot of people don't think about, but it's such a useful tool as well. A lot of self-employed people, and now that you're able to incorporate as real estate agents, you may not want to take full advantage of, let's say, retirement savings accounts, retirement savings plans. So, yes, you get the tax deduction and the tax savings now while living, while putting the money into the RRSP. But of course, when you withdraw from it, it is fully taxable. So
same as a corporation. Yeah, exactly. So there's no point.
Exactly. Yeah. So it's a fully taxable withdrawal. And I think that the idea of RRSPs worked very well in the past, because the idea was that while we're earning income in our younger years, we get the tax savings. And right when we hit 65, we're going to retire and have no income. but that's not the case anymore, right? So we can
Yeah.
even see with most people, especially what we're talking about today, there's significant rental incomes, investment income. So incomes don't go to zero and then, yeah, we'll start withdrawing out of our RSP. That's always going to be an issue, I think, especially with investors, in terms of how can we minimize this tax that we're paying on our RSP withdrawals? And there's no way once you withdraw it, there's tax, right?
Sure.
So one really unique concept is insuring parents. We can think of your own parents and how old are they? So, think of life expectancy. Obviously, we don't want to talk about anything happening to the people we love, but you can use insurance that's insuring your parents as almost retirement savings concept, because you buy a policy that's insuring them, and when something happens to them, that tax-free death benefit gets paid to you.
Yeah.
Okay, so essentially eliminates any taxes that would have to be paid. It's a full lump sum that you can now are free to do what you want with it. So it's a really effective retirement, investment concept that a lot of people don't really think about. So that's another option in terms of insuring your loved ones, right?
Do you need their consent? Just curious. Never thought of that.
They would
I know we
definitely
have to talk
have
about this
to.
still, but sorry.
Yeah, they would have to sign it. It would
Okay.
be on their health, right? So they're going to have to be answering like the
Right.
medical question. They'll be part of the process. And it's so funny because that is actually one of the common questions that like get asked when you talk about this concept. But you'd be
Yeah.
surprised. Most parents are happy to help with something like this. Especially, I think a lot of parents have done it themselves, but maybe a lesser amount than, we could do additional. So it's something that a lot of parents are definitely open to. They're more than willing to help fill out the paperwork, do the application, and get that policy in place for you. So yeah, you definitely need their consent. They'd be part of the process, answering the questions, and that kind of thing.
Yeah, it's definitely an uncomfortable conversation to have, but it's something that needs to be had, or you should have, because this is a powerful concept for sure.
Yeah.
If you had to choose between insuring children or parents, is there like what talk about the advantages and disadvantages of what the pros and cons, I guess?
Yeah, I mean, they're totally different. So again, it's
Yeah.
going to be your scenario, right? Like I
Mhm.
said, insuring your parents is more of a, you can look at the concept as more of a, and again, you'd have to look at what are their obligations going to be when they pass, what kind of
Right.
tax is going to be owed when they pass. If your parents passing is going to trigger a large tax bill, then definitely I would start there, right? Insuring children is going to be more so being able to, yes, protect your family in the meantime. Knock on wood, something were to happen to a child, that's obviously going to rattle a family. But at the same time, it's more so providing them the future protection and ensuring their insurability, making sure that they can get insurance because you're locking it in while they're young and healthy. Knock on wood, as we age, unfortunately, we don't get healthier
Right.
or younger. So they're very different concepts. I wouldn't say one again is better
That's
than the
true.
other, but they're very different.
I mean, because you can essentially, the accessing future cash value, you can also access their future cash value because it's really
Definitely.
your policy
Yeah,
as the adult paying for it. I mean,
exactly.
you may or may not want to do that. That's just something that another
You have
advanced
the
strategy you could use. So I guess it's different options.
Exactly. So when you insure either children or parents, like you can be the owner on on both policies. Definitely, you'll be it on the children. So you're the owner. You have full control of the policy. There's not a certain date that you have to pass that ownership on to the children. That's up to you as the owner. So you're exactly right. If you wanted to access those values on the child's policy, you have that option too. So you're the
Awesome.
owner of the policy. You have that right to the policy.
Now, here's a question that I got from somebody. What if you don't have kids and you don't plan on having kids? Is insurance a viable thing? I mean, I guess you're beneficiary of your estate. I mean, assuming you're going to leave an estate,
Yeah.
to your next person.
Yeah.
I guess that policy is what you'd get it for, right? So, say if you pass, you don't have kids, you leave it to parents or sibling or somebody or charity, even for that matter.
Yeah.
So, what's your comments on that?
Yeah, I mean, definitely. It's gonna, again, depend on your specific scenario. But if you have any kind of estate that you're passing on to someone, any kind of obligations that you're passing on to someone, insurance is definitely going to be probably the most effective tool to ensure that that person isn't overwhelmed or, put into a more negative place because of that passing, right? At the same time, it's not even just, you have to look at, again, that's why I say everyone's different. But if you're a business owner and you have a business partner, let's say, that's one of the biggest things too, to make sure that, two key people in the business are insured. Knock on wood, something happens to one of them, the business can function, you can, retain those shares and so on. So there's so many different reasons that you would need the insurance, but you're exactly right. If there's anything that you're passing on to someone, if there's any kind of bill that's being passed on to someone, whether it's children or even your parents, right? Like if something happens to us prematurely, that's going to go to our parents.
Yeah.
So do you want to put them in a situation where, they'll just have to fend for themselves? Or do you want to make sure that they're looked out for, everything has been thought of, and they don't need to stress or worry about that?
Right, because for real estate investors, if you're talking about passing on property, real estate is largely illiquid. Like you can't liquidate it really quickly, and even
Exactly.
borrow it, you might not have the ability to remortgage it or anything like that. So
Exactly.
this is why insurance is so popular, and this is why I wanted my people to listen to this and,
Yeah.
and hear this conversation. So
Yeah. I mean, I would say it's a medium in terms of liquidity, right? Like even if you can sell something fast, it takes time to get that closed.
3 to 6 months. Yeah, exactly.
Exactly. So, it is liquid in the sense of, yes, you can definitely, cash out if you wanted to, but it's more so a question of how quickly, how much, and how like basically how much are you willing to lower your price to find the buyer, right? So it's not
Right, and whether or not it's the right time to do it. Exactly.
exactly. So
Because
it is
the market might be bad, and you might not want to sell at that time.
exactly. So you want to make sure, these things are just, like I said at the beginning, it's an umbrella. So this investment is an umbrella to your other investments. It's not to say, oh, don't sell those things. It's to say, if now's not the best time, you don't have to.
Right.
Whereas if you didn't have something like that, you'd be forced to. If you couldn't maintain the financial obligations, you'd be forced to do something, right? There's a name for it. It's called a fire sale. And that name is there because they know that person is in desperate need. They want it quick, they want it fast, they're desperate, they need to get this off their hands. So you don't want to put your loved ones in that kind of situation where they're forced to do something that's not the best option that's available to them.
For sure.
Okay.
All right. Well,
yeah.
Is there anything else? Sorry.
No, basically that's it. I mean, insurance is a really effective tool. We talked about it as an umbrella investment. It's great to protect everything else that you work so hard for, that you've built up. And the funny thing is that growth, we look at it as a good thing, right? Obviously, we want the growth in our investments and we want that growth. Otherwise, it probably wasn't a great investment. But that's also kind of like, it's a double-edged sword, because it's great on one hand, but that growth is what's going to leave you with that huge tax bill. Okay. So of course we want that growth, but we just have to be prepared. You have options available to you. It's just up to you which options you actually take advantage of. It takes time, it takes planning, and make sure, you're informed on it, which is what's so great that you're doing this webinar for people, because I do find a lot of people know insurance, but they don't know what it is, how they can use it, and the different types that are available to them.
And even who to contact. So speaking of that, what's the best way to reach out to you, and how's the best way there we go. Awesome.
Yeah, so you can reach me at email, my website, which has my contact information, but the best way is probably through email. And my email is very easy to remember. It's just my name, erica.ca. Yeah.
And if you're afraid to reach out to Erica before that, just ask me for my personal experience, because it's really awesome and powerful. And I wish I did this earlier. I wish I did this in my 20s. It would have been a lot cheaper, but ultimately I'm glad it's happened. As my income grows now, it's probably the right mix, but I just wish I did it earlier, for sure.
For sure. And that's honestly what everyone says. I've never delivered a death claim to a family member and they said to me, oh, honestly, Erica, we don't need all of this. You can take some of it back, right? The number one thing probably people say is like, oh, I wish they did more, or I wish they did it earlier, and that kind of thing. So, I know it's a difficult, like you said, it's like a little bit of a difficult topic to talk about, but it doesn't have to be. It's out of love and planning, and it's really there to help your loved ones. And that's really all it is.
Transition. Yeah. And if you don't talk about it, I know it's uncomfortable and I know it's serious, just like wills and estates and all that kind of stuff. And, prenuptials, if you have that as well too. But ultimately it's very important to have this on the table and talk about it so that you can plan and transition it. And the better you are prepared for it, the better your family will be thankful for you later on. Because it's guaranteed. You're going to die. We're going to die, unfortunately, so. Anyway, Erica, thank you very much for your time. You are the absolute best. You are amazing. Thanks for saving my family and
I
my kids'
appreciate it,
future.
and I'm glad that I can be part of it.
Awesome.
And I think it's always worked for me because I totally agree with you. It's literally a no-brainer.
It's a no-brainer, and the problem is people don't think about this until they have kids, right? Because they want to pass off their stuff to their kids, and by then it's already so late. I wish they started earlier.
I always say insurance is probably at the bottom of people's list when they're single. Then it screeches up a little bit when they get married, but not much. Yeah. Most people don't care about their spouse.
Yeah, it's
the
true.
way they care about their children, right?
That's right.
They're oh, they'll be fine. They can take care of themselves.
That's right. Well,
essentially, when you have kids, it's it's number one. It's number one on your list, and it becomes literally the most important thing. Even before wills, I find people are doing this before wills.
Absolutely. Absolutely.
It becomes such an important, to do, but sometimes it's too late, and not even just about premiums and becoming older, but health, right? Honestly, Ken, this past week has been so tough because I've literally had multiple declines, and people don't realize it, that if your health doesn't qualify for insurance, you can't get it. It doesn't matter if you're willing to pay 10 times the price.
Right.
They just won't give it to you, right?
Right. Because it's too risky for them.
Yeah.
Because ultimately these companies need to make money, right? So
it's all about risk, right? How much risk are they willing to take on? And they're not willing to take on too much risk. And it's so funny because we do find that when the insurance companies either rate people, increase the premiums, or they decline them, it's sad to say, but 5 years later we'll get a call and the person passed away. Yeah. And it's happened so many times. Their statistics and the mortality that they're basing this on it's no joke. That's why I always say for people like you who get preferred, take that as go buy a lottery ticket, because the insurance company is literally telling you you're less risk to us.
Which means I need to keep up the health and continue to work out and eat healthy. So, or not continue to start, I should say. So it's time to really get back into shape. But no, this is a really important conversation. I really, really thank you. And I think everybody listening thanks you. You should reach out to all the realtor partners or the people you have, people like me, your clients, and do these webinars that have an audience, because people need to hear this message. I can't thank you enough. This is amazing.
Glad we finally did it.
Yeah.
Hopefully we can do a podcast in person one day.
Add it up.